New home sales came in stronger than expected last week. Home prices kept appreciating, and the housing data was actually pretty encouraging across the board. The problem is that geopolitical tensions and volatile oil markets are still the loudest thing in the room right now, and they're making it hard for any good news to get the attention it deserves. Good afternoon. The roller coaster continues. As I mentioned last week, heading into a quiet economic calendar, the tensions in the Middle East and their impact on oil prices were going to be the primary driver of the 10-year Treasury and mortgage rates, and that's exactly what played out. Since the start of July, mortgage bonds have dropped roughly 1% in value, and the 10-year Treasury has climbed about 20 basis points to levels we have not seen since January of 2025. The back and forth on whether the escalation is going to end, restart, pause, or drag on indefinitely has put investors in a chaotic spot. Every headline, positive or negative, triggers an aggressive market reaction that trends for a few days before reversing on the next piece of news. It has been a whiplash in both directions, and there is no clean resolution in sight. At the moment, there appears to be a pause in active attacks from both sides, but commercial tankers are still being rerouted around the Strait of Hormuz, which tells you the market is not buying the ceasefire just yet. All of this is playing out as we head into Fed week, with Kevin Warsh taking the reins for his second meeting as chair. All eyes will be on what takes place on Wednesday, but for now, let's get into what took place last week. Here are your headlines. On July 18th, U.S. Energy Secretary Chris Wright noted that approximately 14 million barrels of crude oil per day were still moving through the Middle East, with about half through the Strait of Hormuz and the other half via alternative shipping routes, including Saudi Arabia's East-West pipeline to the Red Sea. At the time, those alternative routes have helped maintain global oil flows despite escalating tensions between the U.S. and Iran. However, reports that the Iran-backed Houthi group proposed a maritime blockade targeting Saudi Arabia raised concerns about the security of those alternative shipping routes. The prospect of additional disruptions increased uncertainty in the oil market, contributing to higher oil prices and renewed volatility. This is a variable nobody can really plan around. Oil is not trading on economics right now. It is trading on headlines. One announcement out of the Middle East in either direction, and you can watch the market move in real time. That kind of environment is impossible to predict and almost impossible to plan around. And it is the single biggest variable sitting between where mortgage rates are today and where everybody wants them to be. Until there is a real lasting resolution to what is happening in the Strait of Hormuz, not a pause, not a ceasefire that lasts a week, oil markets are going to stay on edge and rates are going to feel it every time a new headline drops. That is just the reality of where we are right now. Now, in housing news, after 2 consecutive monthly declines, new home sales rebounded in June, rising 1.6% to a seasonally adjusted annual rate of 628,000 homes. The total came in above expectations, and May sales were also revised higher. Compared to a year ago, however, sales were down 5.6%. Sales increased in the Northeast, Midwest, and South, while the West experienced a 22% monthly decline. Because this report tracks signed purchase contracts, it reflects buyers who were shopping during June. So what is the bigger takeaway? This is one of those headlines that drives me crazy, and I want to make sure we clear it up. A 3.3% drop in the median home price is not the same thing as home values falling, and I think that distinction is getting completely lost in the way it's being reported. Here is what actually happened. In June, there was a notable increase in the sales of homes priced below $300,000, which pulled the median number lower. The median is just the middle price of everything that sold. It does not tell you whether any individual home went up or down in value. If more affordable homes sell in a given month, the median drops. That is a change in the mix of what sold, not a signal that the market is softening. This is actually the same mistake I see made with existing home data all the time. Diana Olick on CNBC does this regularly, and it drives me up the wall. Median price does not equal appreciation. Those are two completely different measurements, and conflating them leads buyers to make decisions based on information that is just flat out misleading. The broader data and forecasts continue to point to steady appreciation. If anything, a pickup in affordable home sales is a sign that more buyers are finding ways to get into the market, which is a positive, not a warning sign. After remaining relatively stable around 209,000 to 217,000 over the last month, new weekly unemployment claims fell to 187,000, which is the lowest level since 1969. Meanwhile, continuing unemployment claims remained elevated and relatively steady at 1.8 million. So what is the bottom line? Labor Secretary Keith Soderling recently directed governors to tighten identity and eligibility verification before distributing unemployment benefits in a direct response to the fraud that ran rampant during COVID. The result is that some legitimate filings are getting delayed or rejected, which means that unusually low claims number may be even less reliable than it was already. Stack that on top of the gig work factor we have already covered multiple times before, people skipping benefits entirely and jumping straight into freelance or contract work, and you have a headline number that is understating the labor market stress in at least two different ways. Continuing claims sitting at elevated levels is still the number I trust the most. People out of work and taking longer to find their next job tells you more about the real state of the labor market than any headline figure right now. After a quiet week, things heat back up fast. This morning brought home price data from Case-Shiller and FHFA as the Fed kicks off their two-day policy meeting. Wednesday is the main event with the rate decision and Warsh's press conference, and what he says is going to matter just as much as what they decide. Thursday keeps it going with PCE inflation, the first estimate of second quarter's GDP, and weekly jobless claims. All three have the potential to move markets, and a lot can happen in this short amount of time this week, and I will be in touch with a full breakdown on Tuesday. But for now, have a great rest of your day.